Hi, everybody, and welcome to the Richard Anthony Autumn Budget 2024 summary. This has brought this budget is under a new Labour government, and we will see what it has brought. I am Edward Rabin, one of the partners here, and one of five partners, and we all cover different various things. And I look at everything from personal tax, company accounts, corporation tax, and everything in between. So if we move on to talking about the budget itself, as I say, this is a new government. It's trying to bring a fresh approach, led by Chancellor Rachel Reeves. In her first budget, Rachel Reeves has made it clear her vision for the UK is an economy growing, creating wealth, and an opportunity for all. The central strategy, invest, 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 which echoes the famous education, education, education commitment of the Blair Labour government. It's not going to be without its challenges. The UK faces slow economic growth, and an apparent £22 billion deficit, which we've obviously all heard of. Rachel Reeves acknowledged the difficult journey ahead, announcing plans to raise taxes by 40 billion, which we should go through. So what Reeves has said is that instead of short-term fixes, as we've seen in previous budgets, this budget emphasises long-term stability. With a focus on growth, she's set her sights on reshaping our economic landscape. So, if we move on to the economic outlook. The government's economic strategy builds on this £22 billion deficit it apparently inherited from the previous government, but it does remain optimistic. The Bank of England haven't changed their inflation target, which has been 2% for many, many years. Reeves has outlined a commitment to balancing and stabilising the economy through long-term focus of investment rather. The OBR, Office of Budget Responsibility, predicts gradual growth in GDP over the coming years. As you can see there, 1.1% in this year, and then 2% next year, and 1.8% in the following year, with some gradual growth through to 2029, the end of the government's current tenure. The steady growth is intended to end austerity, which was the point that she was making, but the government pledging not to borrow for current spending, but to borrow exclusively for investment in projects that benefits the UK's future, such as things in city centres and other infrastructure projects. So if we go on to the next slide, we can talk about the actual impact and what she said in terms of tax. So Rachel Reeves, most of us knew this was coming, particularly within a couple of weeks of the budget, but she has confirmed there were no increases in VAT, national insurance, or tax for working people. However, this budget does introduce significant changes for employers. From April 2025, the rate of national insurance contributions will rise from 13.8% to 15%. Apparently adding an estimated £25 billion to the public purse. Employers will also see the threshold at which NRC is applied drop from £9,100 to £5,000 per employee. So not only has the rate gone up, but when they start paying the national insurance on people's salaries has gone down. So a double whammy there. There is a small flip to this in that the employment allowance will increase from 5,000 to 10,500, and that's for all employers, whereas previously it was only for smaller employers. Further, on the national living wage will rise to £12.21 an hour from April 25. And that increases annual earnings by about £1,400 for a full-time national living wage worker. For younger workers, the minimum wage will see a historic 16.3% increase to £10 an hour. So what we're going to see really as a result of this, Reeves may have said that she's not taxed working people, but she may have squeezed them in other ways, because there's only a number of ways out that businesses are going to deal with this. They're either going to shoulder the costs and frankly accept lower profits or less investment. They're going to suppress employee wages or simply reduce headcount or not hire. Or they will pass on the costs of these increases to customers, which will lead to inflationary pressures, which in turn may lead to future interest rate rises, which ultimately affect those workers that Reeves was intending to protect in the first place. So we will see how this plays out. And if we now move on to capital gains tax. So one of the bigger changes in this budget was an increase in the CGT rate. As at the 30th of October, the date of the budget, the standard CGT rate rates have increased. The lower rate has increased from 10% to 18, and the higher rate from 20 to 24. And the rates for property gains and disposals remain the same. In terms of business asset disposal relief, previously entrepreneurs relief, it will be impacted, but I don't think this was as bad as people thought was going to the impact from this. So the rate until April 25 is still going to be 10% on the first million. From April 25, the rate's going to go up to 14% on disposals of qualifying shares. And then it will go up to 18% by 2026. In addition, the lifetime limit for investors' relief will be reduced to £1 million for disposals made after October 2024, which brings it in line with the business asset disposal relief. I think as a result of these changes, there will be a lot of business owners that will look to make a swift exit before the reliefs change in April. Selling a business relatively quickly can be difficult, so you might find some fire sales reduce, impacts on what businesses go for. There may be some more management buyouts. We'll see how this plays out in the next 3-4 months. So if we move on to inheritance tax. So again, they've really played around with inheritance tax in this budget, going for what they would probably consider the wealthier slice of the population. The inheritance tax, the budget did introduce several key changes. The government will begin taxing the unspent pension pots from April 2027. So that comes in about 2 and a bit years. And this is going to have significant impact on generational wealth planning when it is introduced. People have been planning, pensions for years to protect them from IHT, and this obviously reverses all of that. So we'll see again how that plays out. I mean, this measure will particularly, hit families when there's an unexpected death at an earlier age. When there's more of a pension pot that may remain unspent. So again, there's a lot of unintended consequences that may occur here. Planning around this will be difficult because whichever avenue you take, there's going to be a tax somewhere along the line. But what they didn't do in the budget is to touch the potentially exempt transfer rule, where you can give away a gift, usually money, and if you survive 7 years, that's outside the scope for IHT. So that is still probably the most simple and effective way of planning for IHT. I mean, what I would say about pensions, it is still important, and it's still tax efficient in that the pensions, the gains and investments, income from the investments in the pension still remain tax free once they're in the pension pot wrapper. In terms of further changes, there can be changes to agricultural and business property relief. There's 100% relief will apply to the first million on agricultural and business assets. And after that, the rate drops to 50% of the inheritance tax threshold. So the effective inheritance tax of the assets worth over $1 million will be 20%. And I think what we've seen coming out recently is people concerned to actually create the liquid assets to pay the inheritance tax. So there's going to be potentially double taxation, because if a business passes to a child on the death of the parent, and there is an inheritance tax due, they need the cash to pay that inheritance tax. So they may have to withdraw a dividend, paying personal tax, to then pay the inheritance tax. So there's, again, another potentially unintended consequence there. So there's this double tax concern there. Yes, private business shares, things like AIM, the relief for the unlisted shares will be cut to 50%. Interestingly, what she did do is she said that income tax rates will be unfrozen from 2028. We thought the fiscal drag would go on a little bit longer, but that's some positive news. But the IHT nil rate ban will remain frozen until 2030 at the earliest. So there's that. If we go on to the next slide. The taxation of overseas wealth. Reeves' budget brings fundamental changes to the taxation of overseas wealth, starting with the abolition of the non-dom status in April 2025. In its place will be a new residence-based tax regime allowing temporary relief from UK tax on foreign income and gains for only 4 years. In addition, IHT will now apply more broadly to offshore trusts, effectively ending this common tax shelter and wrapper. For CGT, the remittance basis users can rebase foreign assets to their April 2017 value for disposals, although there are quite strict conditions for this. The budget also scraps the previous 50% reduction on foreign income in the first year. And there's this temporary repatriation facility that will be extended to 3 years with expanded allowances for offshore structures. So quite a lot to consider for overseas wealth and individuals who were previously non-dom here. They're going to have to rethink if they want to remain here in the long term, basically. So if we go on to the next slide to talk about business tax stability, which was one area that Reeves didn't really touch too much, which is the corporation tax arena. The corporation tax rate of 25%, which was brought in by the previous government, that remains the same, as do some key reliefs such as R&D tax relief, full expensing, and annual investment allowance, where you get the tax relief when you invest in plant and machinery and things like that. I mean, this obviously goes hand in hand with the government's overall goal, which is, to encourage innovation and infrastructure. So they said that they're being consistent there. The good news is that first-year allowances for zero-emission cars and electric car and charging points have been extended to 2026, which offers further incentives for businesses to consider sustainable investments. Electric cars have been a very good way of business utilizing business profits and seeing a very low benefit in kind on that. So it's a very efficient way to own electric cars for a company. For the property sector, there are, however, some changes. Landlords and investors will face higher costs if they intend to expand their portfolios, because the additional dwelling stamp duty, i.e. if you buy a second home, the stamp duty was 3%, that's now 5%. So that's quite significant, and we'll see how that affects property investors, developers, and again, rents ultimately when they trickle down. So that would be interesting to see the impact on that. If we go to the next slide. So the government's investment plan, what's it going to do with a lot of this money? So the budget's overarching message was one of investment, as I said. Over the next 5 years, the government plans to invest more than £100 billion, focusing on infrastructure, housing, and R&D. Additionally, the government has established the National Wealth Fund, aiming to attract £70 billion of private investment by supporting it with public funds, which we have seen things like that in the past, but we'll see how that again plays out. Projects are likely across the UK are likely to benefit from this package. There'll be a new industrial strategy, which will target key growth sectors such as AI, innovation, while a pensions review aims to unlock more investment into UK assets by focusing the funds there. The strategies are meant to be forward-looking, laying down the groundwork for sustainable economic growth over a longer period of time. However, already the OBR and the IFS have cast out some of the real long-term credentials of the budget. In response, Keir Starmer has been clear that this budget was only the start of much bigger plans for the nation. But we'll see what comes in the next 3-4 budgets. Final thoughts on the budget. So to wrap up, the budget presents some significant challenges, particularly for small and medium-sized enterprises. I think we're going to be that we won't hear the end of what the trickle-down effect will be and how businesses react to the increase in national insurance and increase in minimum wages. Changes to CGT and IHT will make it much more difficult for business owners to generate and pass on wealth. So they're going from sort of the top down, really. The owners and the workers, I think, will both be affected by this budget. The government's focus is on investment and market stability, and the corporation tax stability has given businesses to plan somewhat what they can do over the coming years. All that's left to say is if you need any further advice or any specifics, we are here to help. So that is the end of the summary. Just having a look at one of the questions that's been asked. Will beneficiaries have to pay the marginal rate of tax in addition to the IHT of pension? Yes, is the answer. The beneficiaries will have to pay. That rule hasn't changed. So if the person died that is 75 or over, the answer is yes. If the person that has died and left the pension, then the answer is no. But in any age, any unspent pension pot will be subject to IHT. So that's that. But again, we're looking. There's a lot coming out about this pension, about how the double taxation, as that question pointed out, how that looks. Okay. Thank you very much for joining, everybody.